Hello. Since my last report, there have been some key changes on the Singapore front. Firstly, GDP contracted 1.1% on a quarter-on-quarter basis. Second, inflation stubbornly remained at over 5%. And thirdly, residential new sales activity declined by 20% month-on-month. Now, based on advanced estimates by the Ministry of Trade and Industry, the Singapore economy contracted 1.1% quarter-on-quarter in the second quarter of 2012. This is led by sequential contraction in manufacturing, particularly in biomedical manufacturing output. Now, the service sector growth, including the financial market, eased from 2.7% in the first quarter of this year to only 0.4% in the second quarter. Inflation remained stubbornly high at 5.3%, driven by imputed accommodation cost and private transportation. Now, if you exclude these two factors, the core inflation is at only 2.7% in June. Now, the office rents face continual downside pressure on the back of modest demand and looming vacancies. While these has encouraged some relocations from outside the CBD, they are largely the smaller outfits. The demand from large occupiers still remains weak, leading to a marginal decline in vacancy level. Now, the uncertainty from the Eurozone, coupled with Singapore's weaker GDP performance in the second quarter, has led market watchers to downgrade their economic forecast, although still largely within the 1 to 3% range as expected by the Ministry of Trade and Industry. Now, in view of the weaker economic performance and new supply coming on stream, we believe vacancy rates for the Raffles Place area will trend upwards, and we expect prime rents in Raffles Place to ease by another 5 to 9% for the remainder of the year. Investor demand remained active, mostly in the strata title market, supporting valuation-based capital values that remain stable in the second quarter. We maintain our earlier view that valuation-based capital values is likely to move moderately southwards, resulting in a slight yield compression over the next 6 months. On the residential front, demand in the new sales market finally saw some softening in monthly transaction volume to somewhere below 1,500 units, 6 months after the last policy intervention on December the 8th. The URA monthly sales volume for private residential units, excluding executive condominiums, fell by 20% month-on-month in June 2012 to some 1,371 units. Now, this represents 2 consecutive monthly declines in volume. The rest of Central region saw the steepest fall as buying activity slowed. Sales activity also fell in the outside Central region, but picked up in the core Central region on the back of a popular new launch. Previous policy intervention is now working its way through the market, and buyers are returning, especially to the core Central region, as landlords become more flexible on pricing. The narrowing gap between the core Central region and outside Central region is also generating greater buying interest. Singaporeans are increasingly supporting sales volume in this region, helping to soak up the unsold inventory. While the URA flash estimates on the island-wide property price index shows an uptick of 0.4% quarter-on-quarter against a quarterly contraction of 0.1% in the first half of this year, the risk of any government intervention remains low. Now, I think this recent price increase is not sustainable, given the overall slower sales activity in both the primary and secondary markets. We can expect overall PPI to remain moderately stable with upside of up to 1% over the next 6 months.